Hello friends, welcome to Learn Easy. We will discuss stock market correction. In the sector of finance and investments, corrections cannot be defined and specified when they will occur. However, they are meant to happen as the stock price dips from its latest peak state. Generally, a market correction takes place when there is a drop of 10% to 20% in the price of a security. Like individual stocks, currency markets, indices, and any asset that can be bought or sold on an exchange. Assets, stock exchange, indices, or the whole capital market itself may go under a correction for days, weeks, months, or a larger continued period. However, market corrections are usually of short period and last for around 3 to 4 months as per the recent financial evaluation. What to do during market correction? A sharp decline is quite difficult to digest even for a seasonal investor. But the corrections are healthy too if the tricks are known to the participants. First, in a time of correction, the valuation of almost all stocks falls. The market sell-off is the perfect time to purchase some fundamentally strong shares for a longer horizon at a steep discount. Second, it is also a good time to diversify the portfolio by including other asset classes such as bonds, commodities, real estate, etc. A further correction would happen in the future too. And it gives an essential lesson to the investors not to keep all eggs in one basket. Third, with the help of a technical analysis, a rough idea could be availed regarding the next movement of the prices in most cases. So, it also gets a good trading opportunity for bearish traders. Fourth, if the investor is sitting on fundamentally strong stocks such as consumer products, then the doing nothing strategy also helps. As in the future, the prices would move up. It won't dent the investor's pocket if the time horizon is for a more extended period. If you find the topic interesting and helpful, may please subscribe my channel and press the notification bell if not done earlier. Reasons for stock market correction. Market corrections are a measure of a healthy stock market, as a consistent rise in the stock market might have unfavorable implications for an economy. Elevating share prices are identical to an economic rise. A constant increase in the values of benchmark might thus give rise to a high level of inflation, influencing resident individuals, specifically low-income groups. Market corrections also limit an asset for becoming overinflated, thereby hindering an asset bubble. Though uncertain, market correction also promotes investments among long-term traders, as they can get the benefit of wealth accumulation via capital gains when market gets better. Such a drop in share prices is notably different from bear markets, as market correction enables an economy to rise even further upon revision of prices of securities following their actual value. There are many causes of corrections. First, weak corporate earnings. At times, stock will move to a correction when it reports weak quarterly earning or guidance. Second, weak macro data. Some assets tend to move to a correction when there is a weak economic data. For example, if a country reports weak GDP numbers, its currency could move into a correction. Third, supply issue. At times, supply and demand dynamics tend to go into correction when there are demand and supply dynamic. Fourth, technical reasons. At times, a financial asset could move into correction because of technical reasons, such as when it is an overbought level. How to predict when a correction will happen? To be fair, it is always impossible to predict when a correction will happen. However, there are some simple strategies that can help us identify when these corrections are about to happen, such as yield curve. A yield curve refers to the overall movements of short-term and long-term treasury bonds. In normal situation, the yield of a long-dated bond will be higher than that of a shorter bond. That is because the extreme future is relatively difficult to predict. Therefore, when the situation changes and the curve inverts, it usually sends a signal that a correction is near. Financial analysts and investors take help from different charting techniques to aid them in predicting and monitoring market corrections. It is quite demanding to evaluate when such a correction occurs because the reasons can differ a lot, from large-scale economic changes to financial problems in the management approach of a single organization. As it is hard to tell advance about a market correction, it is unsuitable for experts to evaluate the beginning and concluding period of such a drop in stock prices. A change in the stock market rates taking place during a trading session is not good for short-term traders who could experience notable financial losses during such periods. That's all for today. Thank you for watching the video.